Bear markets and market sell-offs can feel absolutely brutal. But here's the thing, the smartest investors, they know exactly what to do whenever stocks drop. And today I'm gonna walk you through the 3 most important moves to make during a market sell-off. And these are moves that can help you profit while everyone else panics, all while setting you up for greater long-term success in your portfolio. Stick around and I'm gonna show you the proven playbook to turn volatility into opportunity. So let's start off with a little background here. If we look at all bear markets dating back to 1950 and we look at some of the data and we try to figure out how long the market typically sells off for, how low it actually drops, and then how long it takes for the market to recover and reach its prior high or prior peak again, there's a lot we can learn from looking at the data. And there's several conclusions we can arrive at, which I think are important to put some perspective around how market drawdowns work and how really to profit off of them. So if we go back to 1950, bear markets on average experience a 30% drawdown. So top to bottom, they drop on average 30%. Painful, right? I mean, most people are going to look at the negatives of that situation and they're going to say, oh my God, my 401k's become a 301k. I lost a ton of money as you know, I'm down 30% in the stocks in my portfolio. However, as I said earlier, smart investors know how to be opportunistic and take advantage of these drawdowns. And what happens is typically the market bleeds out for quite a while. I mean, maybe 11 or so months, so just shy of a year, a little over 330 days on average before it then bottoms and it sets its low and it starts to rebound and or potentially snap back, which would be a fast rebound. So typically, when we go back through history and we look at averages, it takes a little less than 2 years from the bottom, 1.7 years to be exact, for you to get back to break even. So it's not like it happens immediately. It does take a little bit of time, but guess what? What goes down eventually comes back up. These stocks, these companies aren't going out of business. So most of them are not going to zero. And if you own larger cap companies, namely S&P 500 kind of names, it's highly, highly rare those companies go to zero. They could get beaten up, but more often than not, all of these stocks will make a comeback. Average drawdown, 30%, 1.7 years then to get back to break even. Now, as I look through this data, and you can see the chart, as I look through it, I think there's 2 major conclusions we can draw here. The first is that if we are talking about a bear market that happens during a financial crisis, so if we look at these 3 different situations, we look at the 1970s. What was the financial crisis that happened in the 1970s? Bretton Woods. So we ended the gold standard. So the US dollar was no longer backed by gold, led to runaway inflation, some pretty serious monetary issues that we had to deal with. So that was an example of a financial crisis. A second example would be the dot-com bust of the late 90s, early 2000s, when you had profitless IPOs like Pets.com coming to market, stock price goes through the roof, and then you realize that the company was a fraud. They weren't making any money. They were profitless. The financial crisis that existed there was really related to the stock market and specifically the NASDAQ with a lot of those tech names. As long as you had a .com in the name, your stock price went to the moon. So there was a lot of fraud and or false valuations in the stock market, which led to that financial crisis. And the third example would be the Great Recession. Essentially 2008 and 2009 is when we experienced that. That obviously was the banking crisis where we saw Lehman Brothers and we saw Bear Stearns go under. A lot of people were talking about banks were too big to fail. You had JP Morgan bailing banks out. So it was a disaster. So when we look at these financial crises, what you will notice is the drawdown is more severe. So rather than the market being down 30-ish%, it's very common that you can see the market drop 40, 50+% top to bottom. The other thing is the market bleeds out longer. So it doesn't bleed out over the course of 6 or 9 or 11 or 12 months. And when I say bleed out, I mean go from, top down to its bottom. Typically, it can take 2 to 3 years. So it's a long, drawn out process. So the reason I tell you that is we need to put into perspective which kind of bear market we are in. Are we in a bear market that's related to a financial crisis? If so, now we know how they rebound, how long they bleed out, and we can act accordingly. Or is it a non-financial crisis bear market? And what I found is that when you look at the non-financial crisis bear markets, oftentimes they are policy related. So a good example would be the COVID bear market of 2020. That was 100% related to policy. You had governors around the country shutting down businesses and telling people to stay inside their homes. That was a man-made, self-inflicted recession and/or bear market that we ended up in. Those bleed out much quicker. So, for example, in 2020, the market dropped 33% in 33 days. That is an absolutely fast drawdown, but it bottomed quickly and then it rebounded quickly. So oftentimes what you'll see happen if the bear market or the market sell-off is related to something, some sort of a policy event or policy issue, the snapback, the time it takes to get back to break even could be 3 to 6 months. And in that specific situation, in 2020, the snapback was only 5 months. And by the end of 2020, we were making new highs in the stock market. So it's very important for us to figure out, why are we in this bear market? Why are we in this market sell-off? Is it a financial crisis? Or is it something that's policy related so we can game plan accordingly? Whichever way we go, whether it is policy related or a financial crisis, the data is clear. Markets do come back. The question becomes, will you be positioned to profit and benefit when they do come back? If this is your first time watching, I'm Mark Tepper. I manage well north of $1 billion of client assets, and I love putting out good financial education for my viewers. If you like what you're seeing, make sure you hit the like button, subscribe to the channel, and ring the bell so you get notified every single time we put out new timely content. And if you're interested, drop some comments and I'd love to have a chance to respond. Strategy 1, put idle cash to work. Now, the key here is if we are sitting on a chunk of cash, certainly that gives us the ability to take advantage of an opportunity that we may be presented with to buy some of our favorite high conviction names on sale at a discount. I mean, some of our favorite names might be down 20, 30, sometimes 50% in a bear market. And if you have conviction in those names, take advantage of that opportunity by taking some of the cash you have on the sidelines and actually putting it to work for you by buying these names when they are low. The key here is not to go in full force right away. You want to dollar cost average into these positions over time. Now, that may cause you to possibly pay a little more than you could have, but it also prevents you from piling into a stock when it's down 20%, only to forego an opportunity to buy it when it's down 30 or 40%. Now, we don't know exactly when any stock is going to bottom. Nobody does. Nobody has that crystal ball. So the key here is to dollar cost average over time. And if we remember how long the average drawdown takes, again, in something like the COVID crash of 2020, that drawdown happened over the course of 33 days. Very, very short and fast drawdown. If you look at an average bear market, the market's going to draw down over the course of 11 months before it bottoms. So my strategy would be to use that 11-month drawdown to build up a dollar cost average and plan for you over the course of that time frame. So assuming you have maybe 10% cash on the sidelines, a workable strategy in that situation would be if the market's down 20%, you could easily put 50% of that cash to work on day one. For the other 50%, you can dollar cost average in a fraction of that every single month over the course of maybe 9 to 12 months so that you can fully participate in any further drawdown that may happen, and or if the market bottoms quickly and starts rebounding, you can buy some of that stock as it's continuing to move higher. But the key is you want to put idle cash to work when you have these buying opportunities, such as a bear market where the market's down 20%, but you want to do it in a very smart, intelligent, and disciplined manner by dollar cost averaging over time. The second strategy is rotating your asset allocation. During sell-offs, bonds oftentimes go up while stocks go down. Bonds rise, stocks fall. It's one of the typical nuances of the market when you look at bonds and stocks from a correlation standpoint. And I gotta tell you, while it may be super uncomfortable, winners in the stock market use this as an opportunity to rebalance. And what they do, they reposition money from bonds or fixed income when it's up to stocks when they're down. In other words, sell high, sell your bonds high so you can buy stocks when they're low. So as an example, maybe you're in a 70-30 portfolio, 70% stocks, 30% bonds. And because there's a market sell-off, there's a drawdown, there's a bear market, all of a sudden your 70-30 asset allocation looks more like 60-40. 60% in stocks, 40% in bonds because the stock portion has come down, it's much lower. What you really need to do, as uncomfortable as it may be, is you get back to 70-30 by reducing your fixed income or bond exposure and you increase your stock exposure. It's just typical rebalancing. Now, the key is you really need to let your asset allocation work for you, not against you. And bear markets are built for rebalancing. They present great opportunities to investors. Before we get into strategy 3, I want you to enter your comments below, and I would love to know how you are taking advantage of market pullbacks in your portfolio. And the third strategy is to rotate your sectors and/or stock positioning, which is probably, in my opinion, one of the most fun things you can do when you're rebalancing your portfolio, because it gives you the opportunity to pick out some of your favorite high conviction names that you love. Maybe they're part of key secular growth themes, and you get to really buy them at a discount and feel great, hopefully, when they rebound and are much, much higher a year, 2 years, 3 years down the road. So one of the things that typically happens in these bear market sell-offs is that defensive sectors like consumer staples, healthcare, utilities, they typically hold up better during market sell-offs and downturns. And sometimes they might be positive if the overall market is down 20%, but sometimes they're down, they're just not down as much. So maybe, as an example, consumer staples might be down 5 to 10%. When the market could be down 20, 25, 30%. So defensive sectors like consumer staples typically hold up better, and growth-oriented sectors like tech and consumer discretionary can oftentimes get hit much harder, and they sell off even further. However, when the market rebounds, what you really want to do is you want to take advantage of the fast rebound you'll see in those growth-oriented sectors like technology, consumer discretionary. And just as an example, when the market's down and it's low and we want to rotate from more defensive sectors and stocks into growthier stocks, a good example would be maybe selling your mac and cheese, Cheerios kind of stocks, and you buy artificial intelligence semiconductors or automation stocks or robotic stocks, something in a secular growth theme that's certainly going to have an opportunity to rebound much faster than macaroni and cheese stocks. And the key here is that defense protects, and you need defense as the market's drawing down, but it's offense that you need to actually win games, and growth sectors bounce back hard. The bottom line, bear markets and market sell-offs test your discipline. They test your mental psyche. But smart investors, they use them to reposition, reinvest, and ultimately rebuild much, much stronger portfolios for the future. Whether it is utilizing cash, whether it's rebalancing or sector rotation, these aren't just ideas. This is the playbook. So like this video, subscribe to the channel, ring the bell to be notified of future videos, and comment below, how are you positioning during this pullback?